1. Hourly wage. Hourly wage. This is the most common form of compensation where you're paid a specific, agreed upon amount of money for every 60 minutes you spend physically working at your job. The major advantage of this system is that if your employer asks you to stay late or work on a weekend, you are legally entitled to receive overtime pay for those extra hours. However, your total paycheck can easily fluctuate from week to week depending on exactly how many shifts you are scheduled to work. You will most often see this structure in retail stores, restaurants, and standard manufacturing jobs. 2. Salary. Salary. This is a fixed, predictable annual sum of money agreed upon by you and your employer, which is then divided up and paid out in steady increments throughout the year. The defining feature of this structure is that you receive the exact same paycheck whether you work 30 hours in a week or 60 hours, meaning there is rarely any extra compensation for working late. This provides a high level of financial stability and makes personal budgeting incredibly easy. It is the standard payment model for corporate professionals, school teachers, and executive management positions. 3. Commission. Commission. This form of earning is directly tied to your personal performance, calculated as a specific percentage of the total sales you generate for a business. The harder you work and the more products you successfully sell to customers, the more money you bring home at the end of the month. While it offers the potential to make a massive amount of money if you're highly skilled, it also carries the massive risk of earning almost nothing if business is slow. You will frequently encounter this high-stakes income model in real estate, car dealerships, and corporate software sales. 4. Tip income. Tip income. This money comes directly from the consumer rather than the employer, given as a voluntary financial reward for providing excellent personal service. In the United States, the service industry relies heavily on this system, allowing employers to pay a much lower base wage while the workers make up the difference directly through customer generosity. Because it relies entirely on human psychology and the mood of the customer, this revenue stream can be incredibly unpredictable from one shift to the next. It is the primary way bartenders, restaurant servers, and delivery drivers earn their living. 5. Dividend income. Dividend income. This is a purely passive payment you receive simply for owning shares of stock in a profitable, publicly traded corporation. When a large company makes more money than it needs to operate, its board of directors will often choose to distribute a portion of those excess profits directly back to the shareholders as a cash reward. You do not have to work any physical hours or sell your stock to receive this money. It just automatically arrives in your brokerage account every few months. It is a favored strategy for retirees who want their investments to generate a steady flow of cash. 6. Capital gains. Capital gains. This type of profit is realized exclusively when you sell a major financial asset for a higher price than you originally paid to acquire it. If you purchase a piece of raw land or a block of company stock and hold on to it for several years while its market value steadily increases, you have not actually made any money until the exact moment you sell it to someone else. The government taxes this specific type of profit differently depending on exactly how long you own the asset before selling it. It represents the primary way wealth is built in the modern financial system.